Let's talk deferred taxes. We have deferred tax assets potentially and deferred tax liabilities potentially. But what the heck does that mean? Let's take a look and walk through a little bit about deferred taxes. I'm not going to go into a lot of detail. I'm not expecting a lot, but it is something that, again, for awareness when you're reading a financial statement, this is some of the terminology you're going to bump into on the assets and liabilities in the balance sheet. So we talk about GAAP, and I previously mentioned that the Internal Revenue Service, the IRS code or the IRC, is not GAAP. The Internal Revenue has its own methodologies for recording expenses and regulating and recognizing revenues and expenses. Much of it is consistent with GAAP, but there are often differences, and you want to be able to take advantage of some of those. So we talked about things like having R&D expenses. So we expense those right away. We don't pay taxes. But there's also credits that the government gives to companies to inspire them to spend more money. So they're going to say, well, we're going to give you a credit right away, even solar tax credits, machinery, equipment purchases, vehicles. We want to get the economy moving. They're trying to slow it down too sometimes, but it can go in both directions. So they use the code to drive purchases in certain directions. So when the code is different than GAAP, we now have a deferral. We need to recognize that, well, our income tax expense is not going to match based on the same percentage rate where we're at with the books versus the IRS. So there are two sets of rules, and sometimes the income is drastically different between the two. So in general, companies want to have the lowest possible tax and reduce their tax liability, which means they reduce their tax liability, they can create more cash flow, use the cash today for things, and eventually they'll pay the taxes. They're not going to get out of paying the taxes. It's just a deferral. It's a timing thing to cut back. And it's perfectly legitimate, perfectly legal, as long as you file according to the IRS rules. So let's consider an example. Depreciation. I mentioned accelerated depreciation, where you have more depreciation in the early years, higher expense, meaning lower net income, with accelerated methods versus straight line, which is a consistent every year, pretty much the same expense associated with depreciation for a certain asset. So in the early years, you can have a lower income per the IRS. That means you'll pay lower taxes, but you'll make up for it at the end. When you have higher income, and if the tax rates haven't changed, which they have, we'll get to that by the end, but if they haven't changed, they will be a different tax rate to go with it. As a result, tax payments are reduced and after-tax cash flow is increased. So that's pretty desirable, something you want to do typically. But in the long run, overall, here's our straight line versus accelerated. Okay, depreciation expense. We're going to have some more expense in the early years and less in the later years, but it will average out. Okay? So it doesn't mean you're getting away without paying taxes, it's just deferring the obligation to pay those taxes. As an example, your $100 depreciable asset, 2 years, straight line's 50 a year. They do accelerated, they can get 75 in the first year, 25 in the second. Assume a tax rate combined of state and federal. We have two tax structures. Some don't, there are some states without income tax, but most states have income tax, except Florida, Texas, and Vermont and New Hampshire. Anyways, South Carolina has income tax. Don't you worry about that. So we have to account for that, take care of that. So deferred tax liabilities, it shows that there's a difference in the tax expense, and we set up a deferral liability right here, DTL, on the balance sheet when we realize we're deferring some of those taxes that are our obligation. We're still going to have to pay them in the future, but right now we've got some benefit from them. And yeah, there's another example here, which I'm not too worried about the numbers at this point. I'm probably not going to ask on a quiz or a test for you to calculate this out. You might see it in the homework a little bit. I do want you to understand it. But again, you're going to see DTAs and DTLs, deferred tax assets, deferred tax liabilities on the balance sheet. I want you to know what they are. So deferred tax asset arises when tax payment is greater than the tax expense. So you've got an asset that you're going to take advantage of in later years. So restructuring accruals will often create tax assets. A reorganization plan, restructuring, those are things. It's all about timing differences between GAAP and IRS recognition. Another example, net operating loss carry forwards. Again, a timing difference. You can deduct taxable losses incurred in the current year, offsetting future income. So that's a loss carry forward that goes with that. And there are year limitations. Those are the tax laws, the tax rules. We're learning GAAP, but again, be aware that that's why tax accounting is a six-figure job when you get in the corporate world. Taxes can save you a bunch of money. How you structure things is probably pretty kind of important. So we have not only deferred tax assets, but deferred tax liabilities. And this is based on estimated tax rates times the expense or loss associated. And what happened to the tax rate changes? Like it did. Well, that threw out some of the folks projecting, saying, well, here's my DTA and DTL, but next year my tax rates change, or 2 years from now, I was projecting the advantage over the next 5 years, and it comes back to haunt you and saying, wait a minute, I got to readjust my estimates, and you will have to adjust the statements accordingly. There's valuation write-offs of deferred tax assets if they're not going to be, if they're not going to have the effect you thought. But the last slide on this, again, I'm not going into a lot of detail other than awareness here. The last slide I do want you to be aware of is the TCJA, Tax Cuts and Jobs Act of 2017. This dropped the federal tax corporate rate from 35% to 21%. We had one of the highest tax rates. So Japan was at 35 and they dropped into the 20s. Most European countries had dropped into the 20s. We did the same. We dropped from 35% to 21%. Eliminated some of the exemptions and some of the deductions, but we wanted to be competitive in the world marketplace, because if someone had choice of establishing a company where there's a 35% tax rate or where there's a 15% tax rate like Ireland, then they went to move to Ireland, opened up their businesses. Intel, a lot of companies have major facilities in Ireland. And that's the reason, was the tax benefits of being in a country that charged less taxes. And now there are other recouping the bill. There's other things that came into the tax law that encourages folks to recapture funds, bring them back home, bring them to the States. But tax earned outside the US, even if cash remained abroad at that time. What was eliminated was an NLO, net operating loss carryback and carry forward that was indefinite. It was capped at 80% of taxable income. There was year limitations put on those and carry forwards and carrybacks. And we had to reevaluate our DTAs and DTLs to the lower 21% tax rate, even though originally he was thinking 35%. That's just the federal, plus the state after that. So those are some of the things that affect business here. Tax legislation is a big deal, and it is something that you want to be aware of and need to be aware of. That concludes our conversation on deferred taxes. Concludes our module 10 discussion, and we'll look forward. I think our next module will jump into cash flow statements, which is actually fun stuff. Cash is where it's at. It's king and queen in operating a business. If you don't have the cash flow, you close your doors pretty quick. You can have profits without cash flow, and you're in trouble. So we'll be addressing that in the next round of presentations. Forward to seeing you soon. Thank you.